Hey, what's up guys? Welcome to IronHawk Research. We are a group of people who are dedicated and passionate about sharing financial knowledge. So today, let's talk about Sharpe Ratio. Sharpe Ratio is a very important concept in portfolio management. It can help investors to identify a better investment strategy. Without further ado, let's get right into it. So what's Sharpe Ratio? The Sharpe Ratio is used to help investors understand the return of an investment compared to its risk. We call this risk-adjusted return. The ratio is the average return earned in excess of the risk-free rate per unit of volatility. And volatility is a measurement of price fluctuation of the asset or the investment portfolio. This is the formula for Sharpe Ratio. As we can see on the top, we have the average return of your portfolio minus the risk-free rate. The most common risk-free rate that we use is the US 10-year Treasury yield. And on the bottom of the formula, we have the standard deviation of the portfolio's excess return. So basically the top is the excess return of the portfolio, and on the bottom is the standard deviation of the excess return. So generally speaking, a higher Sharpe ratio means the portfolio or the investment has a higher risk-adjusted return, so it's better. So why do we need Sharpe ratio? Sharpe ratio provides investors a way to compare investments, because you cannot compare investments just by looking at their nominal returns, because each investment portfolio or strategy would have a different risk-taking behavior. Just like you cannot compare an equity fund to a bond fund, because equity funds takes more risk than bond funds. Then of course, the expected return of equity funds will be higher than the expected returns of bond funds. So if you compare the nominal return of an equity fund to a nominal return of a bond funds, this is not fair. It's not a fair comparison. So here's where this Sharpe ratio comes into play. Sharpe ratio measures the return you get per unit of volatility. So it already has taken the different risk-taking behavior into account. Let's take a look at an example. So this is the ARKK Innovation Fund. From this chart, we can see that from 2015, this fund has a 5-year average annual return of 27%. That's including the recent sharp decline, which is not bad. Now let's take a look at the SPY. SPY is an ETF that tracks the S&P 500 index. For the past 5 years, the SPY has an average annual return of 16%. So just by looking at their nominal average return, ARK has a 27% and SPY has a 16%. Can we conclude that ARK is a better fund than SPY? Of course not. Let's take a look at what their Sharpe ratio tells us. So this is a spreadsheet that I created to calculate the Sharpe ratios for the ARK Innovation Fund and the SPY. So what we have here is the daily price data for these two ETFs for the past 5 years. And these data are from Yahoo Finance. And we also have the daily yield for the 10-year US Treasury bond. We use this as our risk-free rate to calculate the excess return for these two ETFs. So in column E, we have the nominal returns. So in column E, we have the nominal daily return for ARK Innovation Fund. So to calculate returns, we use this formula, B3 divided by B2 and minus 1. You can also use B3 minus B2 and divide by B2. It'll give you the same number. Same thing for SPY. C3 divided by C2 minus 1. So column E and column F shows the nominal daily return for ARK and SPY. So how do we calculate annual returns from daily return? First, we take the average return of the entire column E and then times 252. Because there are only 252 trading days in 1 year. Markets don't open on weekends and they don't open on holidays. And then we use the same formula to calculate the average annual return for SPY. And the risk-free rate, we used the most current 10-year Treasury bond yield. And to calculate volatility, remember on the bottom of the formula we have the standard deviation of the excess return. To calculate daily excess return, which is column G and column H, and here we have the annual volatility for ARK and SPY. Remember on the bottom of the formula we have the standard deviation of the excess return. So to calculate excess return, we take the portfolio return minus the risk-free return. So here we took the daily return of ARK fund and minus the daily return or daily yield of the US 10-year Treasury bond, which is E3 minus D3. And for SPY it's the same thing. F3 minus D3. After we get the excess returns, now we can calculate the volatilities of these excess returns. So how do we do that? We use this formula. First of all, you calculate the standard deviation of column G and H, and then times that with the square root of 252. Remember, because we're using daily return data, and there are 252 trading days in a year. So we get the annual volatility for ARK funds excess return is 37.83%, and the volatility for the excess return of the SPY fund is 19.43%. Now we plug these numbers into the formula. We get the Sharpe ratio of ARK fund is 0.644, and the Sharpe ratio of SPY is 0.839. So based on these numbers, based on Sharpe ratio, although ARK Innovation Fund has a higher nominal annual return than the SPY fund, but the SPY actually has a higher Sharpe ratio than ARK. So which fund is better? Of course the SPY. Why? Because on the risk-adjusted base, on the risk-adjusted level, the SPY is more efficient than ARK because SPY can generate more return per unit of volatility than ARK. This is just like you cannot compare a Honda Civic to a BMW M3. You cannot compare these two cars just by looking at their retail prices, because these two cars are completely different animals. A better way to compare these two cars is to use something like value per horsepower. You take the retail price and divide it by the horsepower of the car, so you get a ratio. This ratio will tell you how much money you're paying per unit of horsepower. So with that formula, now you can tell which car will give you more value. It's just like the Sharpe ratio. You cannot compare two investment strategies or portfolios just by looking at their nominal return, because as I said, each strategy will have a different risk-taking behavior. So you need to take those risk-taking behavior into account when you're comparing those two portfolios. That's why we use Sharpe ratio. The Sharpe ratio measures the return you get per unit of volatility you take. A higher Sharpe ratio means more value. So that's the basic concept of the Sharpe ratio. I hope you like it. If you like our videos, please subscribe to our channel. Thank you very much for watching, and I'll see you next time.